business to now $200,000 of profit, and they're happy because the business is doing better. And now they want to go and buy the new car, they want to go and get into a new house. And so now they're right back to square one, living at now a $200,000 lifestyle.
Thanks for sitting down with me, Melvin. I appreciate it. Tell me who you are and what you do for small businesses.
So I'm Melvin Gatson. I'm a CPA. I also have the PFS designation. So what I do for clients is help them with their tax and accounting needs, help them with tax planning, tax consulting, and some business consulting for them as well. Yeah.
So why did you decide to choose accounting? Were you interested in finance in college? Tell us a little bit more about you. Let's get to know you.
So I played basketball in high school and played basketball in college. And so my mother had worked for the IRS. And so as a backup plan, in case I didn't make it to the MBA, I chose accounting as the backup plan because my mother had that experience with the IRS.
Okay, sweet. So for small businesses, I mean, this channel is dedicated to small businesses, and experts like you can come in and really show us what they need to do. I've had cases where people are operating $100,000 of an annual revenue small business, and they're doing it as sole prop, right? And one of the things that I learned was, sure, having an LLC is important, but the S-corp designation is something that needs to be discussed with an accountant.
Yeah.
Let's talk about S-corp and what it is and what are the intricacies and the details of S-corp and how small business can leverage it.
Yeah, so when you're operating as a business owner, choosing your entity type is definitely something you want to talk to with a CPA, sometimes a lawyer. They always say that the two people when you start a business that you want to work with are CPAs and lawyers. Mm-hmm. But I would say CPA is probably the first stop that I would recommend. So when you're choosing an entity, everyone knows that LLC is the most popular form of an entity to have here in the U.S. An LLC is flexible. When you initially create an LLC, you're taxed as a sole proprietor by default. They also call it a disregarded entity. Mm-hmm. After you begin to make money in this business, there comes a point in time where we call it graduating to S-corp. And what we mean by that is the business is making profit, which means more income than its expenses. It's making profit of, say, $30,000, $40,000 per year, and you expect it to continue. At that point in time, you'd want to work with a CPA to determine whether or not it makes sense for you to be making an election to be taxed as an S corporation.
Mm-hmm. Is there an exact amount of that net profit that needs to be hit as a target before considering to change into an S corp?
It's subjective, and you have to take into account a variety of data to make the determination. Just to give you an example, let's say you're a commercial real estate agent and you have an LLC. Commercial real estate agents are known for having big deals, and then it's very slow. And so if they made, say, $40,000, $50,000 of income in 1 year, but then it's just very slow going forward, we may not necessarily want to elect to be taxed as an S corporation, because we're looking forward into the future and projecting like where their income is going to continue to be. That's why I said if you're making $30,000, $40,000 and expect it to continue, then that's where you really start to want to have that conversation. The thing about being an S corporation or being taxed as an S corporation is that it comes with additional compliance requirements. Like your business paperwork life has become more sophisticated, a little bit more costly, and so that's the reason why we have that threshold, is because we have to do a cost-benefit analysis of, does it make sense for us to pay this additional tax preparation cost? Now we have to deal with a payroll provider, because now the tax law requires us to have the owner on payroll as an S corporation. Now we have additional tax return to file as an S corporation. And so once you've evaluated, yes, you can save money with an S corporation when you're making money, but you also got these other compliance requirements now. And so that's where, like I said, about that $30,000 to $40,000 of profit is when you want to evaluate that. And I want to add one more thing to that too. Oftentimes, somebody may be making $30,000 to $40,000 of profit, but they're not taking all the deductions that they could potentially be taking. Let's say they have children that are under the age of 18 years old. They could be paying their children, hiring their children in the business, thus bringing the income down from that $30,000 to $40,000 range to now they're, 25 or 20. And it didn't make sense for them to be an S corporation. So they're saving money by hiring their kids and keeping their taxes simple. And so that's why I said working with an advisor would be good.
So simplicity is the primary goal, or do you think? I guess you just answered it, because it really depends on the complexity of the business and the growth. So I've seen people that have hiring their kids just to be able to avoid tax consequences. And for me as a lender, when I'm faced to review your past couple of years of tax returns, I like to see that you've made money.
True.
Right? I'd like to see that you haven't written off a ton of things, now putting you in a position where you can't really cash flow. But I know your business is a good business.
Yeah.
But in our underwriting guidelines, you're not really checking off the boxes for me.
Yeah.
Is that conversations that you normally have with small businesses?
Oh, yeah. Yeah, that's why it's important to, I look at myself as an advisor to my clients, not just a CPA where you come in and get the tax return done. Not everyone likes that, but I would say most people do. It really is just, do you see the value of that CPA trusted advisor relationship? But yes, when someone comes in, I want to know what their goal is. I want to know what their plans are in the future. Because yes, if you come in and you say, I have this problem because I've been paying too much taxes, right? And I'm like, okay, that sounds good. I can help you with that. We can look at the tax return and figure out if you're not taking all of the deductions that are available to you. But let me ask you a question. Are you looking to buy a home anytime soon? Are you looking to get a car anytime soon? Are you needing financing for any reason? Because you have to show income in order to be able to accomplish those things typically. And so, it's a part of the process.
The conversation, you as a CPA, that you have small businesses. Oh, yeah. Okay, I guess that conversation bleeds into cash flow management. Yeah. Certainly a conversation that small businesses need to have with their CPAs, account receivables, account payables, so what is coming, what's going, understanding their business operation. Sometimes I've seen the small business owners are great at running a business, but when it comes to the finances, maybe they're not the best person to really oversee that side of their business.
Yeah.
Let's talk about cash flow management. Like, just give me an ideal things that a small business owner needs to have, or at least think about when it comes to cash flow management.
Well, one of the things is you definitely want to have some reserves. When you're operating, as a business owner, you're going to have expenses that are, recurring in nature. Let's say you got rent. Let's say you have payroll, insurance, things like that, right? You need to have cash in the bank that even if it takes a while for you to collect on some of your services, that you can still pay for the overhead costs that you have. And so I typically recommend that, you have 3 to say 6 months, as far as reserves. It doesn't necessarily have to be in a checking account. It could be in a money market or a savings account, or potentially even in some equities. But you need some liquidity because as a business owner, generally the revenue it fluctuates. You know, fluctuates maybe due to your peak season. We're coming into my peak season, right? But your peak season may cause variability in your cash flow. You may have a slow period of time. My construction, real estate, like renovators and things like that. I mean, when it gets cold, it slows down for them. I've got some people right now that are dealing with that. And so, yeah, having reserves are key.
It's quite important.
And also, doing some sort of a projection, a cash flow projection is important. It doesn't have to be perfect. You can work with a CPA or, you know, a trusted advisor of yours to look at like, okay, this is what I anticipate in terms of my expenses, my income over the next 6 months, 12 months, and project where you see your cash balance. And you have to include you paying yourself too, because that's where a lot of business owners, you know, that's where a lot of the cash from the business ends up going, is the business is making profits and the owner is withdrawing those profits. And let's not forget taxes. That's a huge component of it.
The biggest expense probably.
It's definitely, I mean,
One
let's
on
just
top.
say it's taxes for a profitable business is going to take 20 to 30% of your profit. That's definitely a huge consideration.
For sure.
So what I've done is created a mechanism or an approach to be able to, even when you're not, because some people just can't afford to talk to their CPA every single month. You know, CPAs are like lawyers, financial lawyers in a way. You know, there's fees associated with, you know, spending time with them. And so, you know, maybe we're talking on a quarterly basis. And so I've created a structure where, you know, we basically say, when you move money from your business account to essentially pay yourself, that you're self-withholding and keeping some taxes to the side so that you can pay Uncle Sam when the time comes.
When the time comes. Well, so that bleeds into budgeting, right?
Yep.
So budgeting and expenses is something that people need to consider. So taxes, give me the brackets, like the top 5 brackets the small businesses need to consider as they budget for a year. I mean, we're just getting started with 2024 right now, right?
Yeah.
So I think it's just a perfect time. Sure, you're going to have a good discussion with your CPA or accountant to be able to help you turn your taxes, file your taxes, right?
Yep.
So what are the brackets that you consider that are top?
You know, like kind of the top factors, if you will, when it comes to like budgeting.
Yes.
So taxes are a component, as we discussed. Rent, payroll. You know, those are probably some of the most important. Insurance is important too. I mean, essentially, what I would encourage a business owner to do, and I would encourage them to take the time to do this, and you really only need to do it maybe a couple times a year, but look at your expenses and then divide them between fixed costs and variable costs. You know, like your rent is a fixed cost. It's the same amount every single month. But as a business owner, there are some things that are variable in nature. Like, to give you an example, it's peak season for me. My payroll is normally a certain amount per month. When it's not peak season, my payroll is going to go up. You know, so I have to take that into consideration, and I would put that in my variable bucket as I'm doing a budget or a projection. And the reason why that's important is the amount of cash reserves that I have needs to reflect that. I need to have more money kind of set aside, or at least planned for, when I'm pulling money out to pay myself. Like, maybe we need to keep a little bit more money in the bank. But the key is all these plans and things that we discuss, we write them down, right? Like, you can talk about them. Most business owners know their business like the back of their hand, right? They instinctively feel their business. They have a good pulse on it. But it's an entirely different thing to take that information that you have in your head and put it on paper, put it on a spreadsheet, and basically say, all right, you start with your revenue. So that's kind of one of the factors that I would say is the first thing we need to do is is do a projection on what we expect in terms of revenue. So you can look at historical to say, okay, typically we grow by about 20% a year in revenue, something like that. Newer businesses grow faster. So we do a projection with that 20% assumption built in. And then we say our variable costs are likely going to go up as a result of this increased activity. Our fixed costs will continue to stay the same, but we'll evaluate whether or not maybe we need a bigger office. Now our fixed costs have gone up, but then you end up with a bottom line, right? And then we have to plan for, like, if you have clients that are slow to pay you, right? Your revenue goes up, but your accounts receivable is going to go up, which means that your cash balance is going to be a little less, even though you're making more money. All of that, you would put it all down on paper. And it's the best thing you could do is just bring somebody in who knows how to do it, and they can translate that information you have in your head about your business on paper.
On paper, on a spreadsheet.
On a spreadsheet.
That makes sense. Okay. Financial audits.
Uh-huh.
I think it's very important for businesses, especially that have been operating for an extended period of time, to consider an audit with a certified CPA. What is the time frame, in your opinion, for an established business to say, I think it's now that I need to bring a financial auditor to take a look at what's going on in my business for the past couple of years?
That's a great question. So I used to be an auditor. Now I specialize on the tax side of things, but I still have to deal with auditors from time to time. Some of my clients are nonprofits, they get audited. So I would say that number one, you'd have to figure out whether or not you truly need an audit, because there are other types of services that auditors perform. So just to touch on that a little bit, an audit is kind of like your deepest dive into the financials. An audit is, the goal of an audit is to get a financial statement that the auditor is essentially saying those numbers are right. They're right in a material respect. In other words, it may be a little off, but we've done procedures on the books to ensure that it's not significantly off. That's an audit. And essentially an audit is going to be inspecting records. They're going to go all the way down to an invoice and make selections based on like statistical analysis. They'll make selections from your financials and inspect records, like actual records. An audit is not always needed. We call that an attestation service. Essentially, the auditor is attesting that the financials are presented fairly. But there's also another level down. It's called a review. And a review is very similar to an audit, but they don't go as deep, but you still get assurance. You still get that attestation that the numbers are just about right within material respects. And typically, a business that's looking for something like what you're describing, they may be looking more for a review. Let's say the review happens every other year, and audit happens, say, every 5 years. Something like that. And audits are more expensive because they are more of a deeper dive. Reviews are cheaper. So yeah, I would say
maybe a review is first.
Maybe a review
instead of just jumping into audits.
Yeah, but I will say this though, engaging in like an auditor or someone who's going to do a review, which has to be a CPA. They're the only profession that can do that. There's other benefits that come along with that, which is things like internal controls, recommendations around the risk and things like that exist in businesses. Business owners oftentimes don't realize all of the risk that are present in their business. And so just something as simple as, you may have a business owner with $300,000 in a cash checking account. And the FDIC only insures you up to $250,000, if I remember correctly. You're in banking, right?
That's correct.
So there's a risk that if something happens to that bank, you would have lost $50,000 in that situation if you had $300,000 in the bank, right? So just something that simple. And there's many other types of risks that exist, but that was just one that kind of came to mind for me. And so an auditor, engaging an auditor for a compilation service, which is the lowest level, a lot cheaper than a review and an audit, but a compilation, a review, or an audit, that firm that's performing those procedures really it's an educational process. And it adds a lot of value in terms of how to structure the business to ensure that the financial information is accurate.
Makes sense.
Yeah.
What are indicators? What are indicators that if a small business needs to start with a compilation or a review or progressively graduate into an audit? What are the signals that are thrown out for a business owner to just say, all right, maybe this is time?
I would say most businesses don't voluntarily get attestation services. Oftentimes, what's happening is there's a party involved that's wanting them to have an attestation service, like an audit, review, or compilation. So let's say you got a bank, and the bank has lended them money, and they have debt covenants in the promissory note of this loan, and the debt covenant is essentially just saying, hey, you can't borrow too much more money because we don't trust that you'll be able to pay back this loan you owe us. So we're not going to allow you. We're going to kind of control some of your activities. And how do we control your activities? Well, we're going to make you get an audit so that the auditor, they're going to know you have these debt covenants because they're going to be requesting information on your lending and stuff like that. And so the auditor is going to report that your ratios are in line with the debt covenant. Another situation could be, happens with nonprofits a lot. They get grants from kind of these larger institutions and stuff. Well, the grant may be for a particular purpose. And so, if you give a nonprofit $100,000, $200,000, $300,000, you want to know that that nonprofit is handling that money appropriately. You want to know that when they tell you that they're spending it on X, Y, and Z, that somebody's looking over it. So a lot of times the grantors require an audit. What else? Investors. That's another one. Say you have several partners in a business. Some of them are silent partners, limited partners, passive partners, if you will. They just get a financial statement of what the business has done. How do they know it's right? They want to bring in an auditor. But typically you'll see that these types of organizations and businesses, they all have a common theme, which is that they have a pretty large amount of money that they're dealing with, which increases the level of complexity. And that is the reason why they are wanting this audit, because it's more complex. So generally, the business is going to probably have revenue of I would say over $500,000 to $1 million is probably where you would see it start. And also, because they have that level of income, then they typically would be able to afford to pay $5,000, $7,000, $10,000 for an auditor to audit their books.
Inspect and audit their books. Okay, well, on that investment side of things, I guess one of the things that a small business needs to do before seeking investment is, they need to become a C corp or an actual corporation. If I'm not mistaken.
It's common.
What kind of advice do you have for small businesses that are seeking investment? What do they need to get together before they can just say, all right, I have an investor now, instead of just simply adding the investor as a part of the business owner? A proper investment injection to come into the business. What do they need to get together?
Yeah. So if someone came to me and they had an investor, one of the things that I would recommend is that they deal with a lawyer. I can assist from a tax perspective, helping them to understand, and I would have to talk to them about what type of business they have and what their plans are and things like that. But a lawyer is going to be key, because if an investor is giving money to a business owner, then the investor wants to have some assurances about what's going to happen with their investment. You know, and it just really protects both parties, right? Like if someone gives a business owner, an investor gives a business owner $100,000 and they don't have the proper paperwork drawn up, let's say the business owner has $100,000, he's deployed the capital, he or she's deployed the capital, you know, according to some oral agreement, but there was some nuance that they weren't on the same page about. Now the business owner, the investor says, I need to get, you know, $50,000, $100,000 out of this business. Cut me a check.
Yeah.
Now you have a problem if they didn't discuss that, and he or she doesn't have the money as a business owner. So the lawyer is essentially going to be in place to make sure that both parties have a very, very, very clear understanding about how this business relationship is going to go, and also in the event that there's ever any disagreement, any wrongdoing, this is how it's going to get resolved. It's essentially like a prenuptial agreement for a business
to engage in prior to working together.
Oh yeah.
That makes sense. Okay, what is a healthy debt to equity ratio in your opinion for a small business to have? And so when they consider about, all right, I'm interested in taking debt for my business to grow it for whatever reason, it could be payroll, it could be expansion, or it could be inventory.
Yeah.
What percentage should they keep in mind to just stay healthy and they're not really exposing themselves to marginal errors that could potentially collapse the business?
That's a good question. It really depends on the industry. Depends on the cash flow of the business. But typically you would want to see, you know, assets over debt. In other words, you'd say 2 to 1. You know, I would say that's like very safe generally.
Yeah.
Is that, you know, for every $1 of debt that you'd have $2 of assets.
Yeah.
So that way, if there was ever a problem, say you needed to liquidate, you'd end up positive in that scenario.
Yeah.
You know, and sometimes certain assets aren't as what we call marketable, so it's not as easy to sell them. So you want to have kind of a buffer, if you will, of assets over debt. But yeah, I would personally say 2 to 1.
Even on underwriting guidelines, it has to be 1.25 of an equity ratio to 1 for us to feel comfortable lending into the business. And I think that's a little slim, but it's manageable, especially if there's assets.
Yeah.
I mean, of course, if you have assets, we're not really worried about you. All right, so business owners, they're, like you said, they know their business like it's the back of their hand, right? And they know their pulse. And I thought that was a very good point. Like, it is true. They know exactly what's going on with the business throughout its life.
Yeah.
Right. How much thought do they need to put into future retirement for small business owners versus investing in their business? So you see, it's like somebody in their 40s, let's say. They have a successful business. They're making about $100,000 a year. They want to grow it at that 20% rate, and it's working, but it requires capital, right? But at the same time, you're 40, right? So how can you juggle that and really think it through before making that decision of like, all right, this much for my business and this much for myself when I retire? Yeah,
it's definitely not thought of enough.
Right.
Especially in like the smaller business world,
Right.
Businesses that are making say $100,000, $150,000 of profit. The problem that I see oftentimes with the smaller businesses are that the business owner's lifestyle is draining their profits from the business. So to clarify my point, let's say a person lives on $150,000 a year, like their personal expenses cost them that much. and then their business is generating $150, $170, $80,000 a year, and then they still have to pay taxes. So they end up with like $150 to basically pay their personal expenses. They don't have any money left over to save for retirement in that situation. That is what I see a lot happening with the smaller businesses. And that may be okay depending on where you're at in the business's life cycle, if you intend on making some strategic moves to grow. But then lifestyle inflation kicks in. So now the business owner has grown the business to now $200,000 of profit, and they're happy because the business is doing better. And now they want to go and buy the new car, they want to go and get into a new house. And so now they're right back to square one, living at now a $200,000 lifestyle.
Yeah.
And so,
just to follow up on that, do you think our current way of living has influence in that? Because I do see it as well. There was a guy that was talking recently who was comfortable making $150,000 a year. Now, since he has upgraded to the millions, now he's going to have to live with the Bentley and the Rolls Royce and the expensive apartment that he has to live in. Do you think our current culture has a major influence into that?
Yeah, I read a lot of like self-improvement books. It's like a human characteristic, that we've acquired from many years of evolution, if you will, staying with the herd, so to speak.
Right.
And so you stay with the herd, you're more safe, better chances of survival. And so what happens is you want to, what they call, keep up with the Joneses. So, if you're making $100,000, $200,000, you're going to consistently align yourself generally with people who are making that same type of money, and you want to keep up with the Joneses, and you almost have to kind of go against the grain, if you will, because it's just so common. So you have to almost go against the grain of what's conventional in order to do the right things. It's almost like eating healthy or anything, any other type of habit that we have. But yes, I mean, here's the thing. From a tax perspective, saving for retirement is very beneficial. They've got 401ks, they've got, defined benefit plans where you can put away a ton of money that would be, a lot larger when you go to retire. Very excellent opportunities for you to enhance your wealth and be wise about, saving. As a business owner, you have so many options. But the first thing that has to happen is the business owner has to essentially create a budget on their personal side and manage it. And like a very, very small percentage of people do that.
Right.
And that's where it's happening, is they're so focused on the business and they're, kind of go, that on the personal side, they're just kind of letting it go.
It's ignored.
Yeah.
I've seen small businesses, on the contrary to that point, almost suffocate a business to death by not spending money on where it needs to be spent, especially these days in marketing and getting exposure. Do you see that happening, or do you normally see that on the contrary, on the other side, where just businesses are just spending a lot of money on their personal side from their businesses, kind of commingling their funds?
Yeah, the commingling is definitely not good.
Do you want to talk about that, maybe?
Yeah, I see that a lot. Commingling happens a lot, and by commingling, we're just essentially saying that the business owner is spending from the business account on personal items, personal expenses. So you see that it has some detrimental effects, because essentially what the tax law calls it a constructive dividend. Is essentially when you pay for something out of your business bank account that's personal, the tax law is saying that that's basically you taking profits out of your business. And that is taxable. The profits itself is taxable. So while your business bank account has went down, it went down not because of a business expense, but because a personal expense was done inside the business account. And so what that does is it creates confusion and complexity, and now the business owner ends up probably not planning for the taxes very well, unless they're using a CPA, on a very frequent basis, like every month or something like that. And so the commingling is a thing. Then also, to your point, not making investments in the right places. Number one, a forecast. You got to have a goal. Begin with the end in mind, so to speak. Is a quote that comes to mind. Where's the business at, and where do you want it to be? And that should dictate where the money is going, right? So if you want your revenue to grow by 25%, you would, like we talked about, put it on a spreadsheet, and let's figure out how it's going to grow by 25, 50%. So yes, you would have to allocate some money to advertising, or you would have to, as a business owner, spend time on the ground advertising. That's one thing that I've talked about with some of my clients, is sometimes the financials are not a true reflection of what's actually happening in the business. To give you an example, me right now, in a way, this is some like promotional type advertising activity that I'm doing, but that won't show up in my financials at all. I'll have wages, and it'll be sitting on the wage expense line on my business's financials. But when you really think about it, my time is probably 15%, 20% advertising and marketing, maybe 50 to 70% of it's operations, and then I'm spending the remaining percentage essentially managing the business in terms of structuring it and things like that, along with my business partner. And so the goal should be, for most people, to your point about retiring and things like that, is that at some point you have to exit the business. So you want to get the business prepped and structured in such a way that it doesn't need you so much. And so if I was able to quantify, like, how much time am I spending advertising and marketing, and how much would that cost if I were to have someone else do that? Because I'm not going to always be inside this business,
Yeah, I love that point, and it just brings me to my final discussion subject: succession plans. Succession plans can be in the form of a sale, like you're talking about, as an exit, or it could be in the form of passing down the business to family members.
Yep.
Or in case, God forbid, something happens to you, what happens to the business? What happens to the debt that you're taking on the business? How's that conversation like with your small business owners? How does that go? Is that even considered?
It doesn't happen enough. For the smaller businesses, it doesn't happen enough. For the larger businesses, the businesses that are doing, well over $1 million in revenue, and, let's say they're doing $250,000 of profit every year and more, for those, and they're still small businesses, really, under, I believe, 50 million is considered a small business.
Small business, right.
But they're, among the small businesses, those businesses are larger, and they do a better job of the estate planning, succession planning conversations. But it's not talked about enough of, okay, what are we doing? Where are we headed? But then what are the risks that exist there? And ultimately, what do you want to do with this business? Like, what's the end game? But there's a great book that I was reading recently. It's called 10X is Better Than 2X. And it kind of talks about the idea of succession planning of, like me, I process tax returns. But at some point, I need to start to remove myself from that part of the business. I help to structure, and I do a lot of advertising and selling and things like that. At some point, I need to remove myself from that part of the business, right? If I want to have a business that can scale, right? A business that can grow without you. So that way, you do have the ability to exit that business,
Yeah.
and it's worth something. And now, when you sell the business, you end up with money, and essentially you have what they like to call taking your chips off the table. You know, you've grown a business from, say, 0 to now the business is doing $500,000 of revenue. And if you structure that business properly, you could sell it. You may be able to sell it for $500,000. And now you can diversify, you know, because you're building up this equity in the business, but now you can diversify your portfolio, or, you know, allocate your time in some other way. But I would say, just to kind of round out the, you know, estate planning, succession planning conversation, I would encourage people to read that book, 10X is better than 2X. And I would also encourage people to talk to their CPA. Probably the first person to talk to is, I would say, a CPA, because a CPA is going to have a lot of contacts: estate planning attorneys, financial advisors. These are people that me as a CPA, I work with all the time. So you can have a will or a trust or a combination of the two, so that if something happens to you, whether you're incapacitated, you know, a lot of people don't think about this, but if you have an LLC with a bank account, the LLC owns the bank account, and you as a business owner are a signer on the bank account. But you as the business owner doesn't actually own the bank account, the business does. And so if you have your estate planning documents in order, your trust would own the business. And you hear it a lot on social media about, oh, you own nothing, your trust, you know, own nothing, control everything. It's not as attractive as they make it sound in terms of like saving money on taxes, but it's definitely a get your affairs in order key piece. If you have it's called a revocable living trust. There's two types of trust: a revocable and a irrevocable. But when you're living, a revocable is generally the way you want to go. Irrevocable trusts are for the wealthy generally. But a revocable living trust is essentially it's basically a contract where you have set up instructions for if something were to happen to you, that you would have someone else step in on your behalf to handle your affairs. So let's just say me and you are really good friends, and I've set up a trust using a lawyer that if I have a stroke or I get into a car accident or anything like that, if I'm the only person that's running my business, I have access to my account, as soon as that triggering event happens, Emmanuel can go and continue to operate my business, make sure my vendors get paid, maybe even sell the business on my behalf, you know, and all that's instructed through a trust. And so, or say you pass away, what do you want to happen to your business? All of that would be documented in a trust. And so I highly encourage that people have these types of plans, getting their affairs in order, because the risk is real that, you know, something can happen to you, and generally you don't have time, you know, to get those affairs in order once it's happened.
That's a very good point. Melvin, this has been very insightful. Your website, your name, your company, your contact information, how can people get hold of you?
So I would say the best place for people to get a hold of me would be at my website, GatsonCPA.com. That's G-A-T as in Tom, S-O-N CPA.com. It's got my email, phone number. You can schedule a meeting on there. Happy to help anyone who wants to have a consultation and see where we can take it from there.
Certainly. Thank you.